I'm delighted to welcome you to this, the 18th Annual World Leadership Forum. In this, the 100th year of the Foreign Policy Association. We've never been more committed to ventilating the important issues in world affairs, and this is evidenced in our outstanding roster of speakers this morning. I'd like to thank Brendan Dhar and PwC for their hospitality. Without further ado, I'd like to turn the floor over to Neil Dhar, a partner at PwC, to moderate the first panel. Neil?
Good morning, everyone. My name is Neil Dhar. I'm a partner at PwC based here in New York. I have the privilege and pleasure of leading our financial services business. So I spend a lot of time in the private equity, insurance, banking, and asset management world. Today, our first panel is going to talk about domestic trends. We have a fantastic panel. Maybe I'll give our panelists a minute to just introduce themselves. So maybe Kathy, if you could start.
Sure. Thanks, Neil. Kathy Bostjancic, work at Oxford Economics, head of U.S. financial market analysis. Prior to that, at the Conference Board, and spent a good number of years on Wall Street with these two fellows.
I'm Michael Gapen. I'm head of U.S. economics research at Barclays. I've been with the firm since 2010. Prior to that, I spent a decade in Washington, D.C. at both the IMF and the Federal Reserve Bank.
I'm Kevin Logan. I'm with HSBC. I'm the chief U.S. economist. I'll give away my age by saying I've been in the financial business since the early 1980s. So I've seen a lot. I've been at a number of major investment banks during that period. I even like to joke, if you haven't changed jobs, you really haven't been in the industry. We're a primary dealer in government securities. We trade foreign exchange, bullion, financial instruments, and my job is to advise and provide information to our risk takers and to our clients. One way to describe it is I try to keep people out of trouble, mostly.
So why don't we get started here? Obviously, the backdrop of the U.S. specifically right now, as we see our clients and sort of spend time in the marketplace, it's quite positive in relation to just generally speaking. You have a stock market that's very robust. You have a job market that's very healthy. General enthusiasm. Obviously, some volatility. Obviously, in relation to what's going on around the world. With that, obviously, let's start off with just from a timely standpoint in relation to what's happening with the FOMC meetings in relation to maybe just a prediction of kind of how things are going to play out later this afternoon, and then more importantly, perspectives in relation to what that's going to mean for the economy in the U.S. near term and as we go into 2019.
So I'll take that one. The Federal Reserve Open Market Committee is meeting today. They'll make a decision about the near-term course of monetary policy. It's expected that they will raise the target rate for the federal funds rate. That's their policy instrument. It's currently 1.75 to 2%. It's going up 25 basis points before today's over. That is built into markets. It's been built into their communications for some time. It's already happened as far as markets are concerned. So there will be a rate hike today. What people will really be interested in, however, is what the communication will be regarding the future course of policy. Now, Fed officials have already indicated that they think that gradual increases in the federal funds rate will be appropriate. So there's more coming. They've already signaled to markets that they think that it will be appropriate given the current state of the economy, robust financial markets, a low unemployment rate, a steady growth, in fact, above trend growth in GDP, that low interest rates are not really appropriate right now, and they should be raising those rates. They should, in a sense, be leaning against the strength of the economy in order to keep inflation expectations anchored where they are now at roughly 2%, and to ensure that inflation won't be rising perhaps next year or the year after that. So that's the plan, and it's been well communicated, and it's built into market expectations. We'll have a rate hike today, and we'll likely get one in 3 months in December. That's what gradually means. When they say gradual changes will be appropriate, it's come to mean every 3 months, every quarter. And so we can expect another rate hike at the end of the year. Now that will take the Fed funds rate up to about 2.4%, where it is today, about 1.9%. another 50 basis points. Now, how significant is that? What does it mean? What will it mean to you? Well, if you have any savings and you have them in a money market fund or an online savings account, you're likely to start getting notices saying, hey, we're raising your rate above 2%. We'll pay you a little bit more. You might like that. I don't know if that'll encourage you to save more or maybe spend more. But it should have some effect on people's behavior. More importantly, it's likely to have some effect on people who borrow money. The automobile market, for example, short-term loans are what drive that market. Well, the cost of getting those loans will be going up a bit. And that's in a market where already the sale of automobiles has flattened out over the last few years. It's going to get a little more expensive. Mortgage rates. Well, that's a long-term interest rate, but as the Fed pushes up short rates, longer rates might rise as well. Right now, for the last many years, mortgage rates, 30-year mortgage rates have been 3.5% to 4.5%. Well, now they're approaching 4.8, maybe 4.9. Soon they'll be at 5%. What effect will that have on the economy? So the Fed's decisions matter. They should matter to you or to the general economy. But the Fed has made this decision already. We know where they're headed and we know why. But the real question, the more important question, is what happens next year? Fed officials try to give forward guidance. They indicate as a group what they think will be the appropriate level of the federal funds rate at the end of next year and the following year. And so we can see their opinions. And we know what their median projection is. Well, they're projecting another 3 rate hikes in 2019. So when I said the federal funds rate would be at 2.40, 2.4%, if they follow through on that, another 75 basis points, 3 25 basis point rate hikes, it'll be well over 3%. It'll be closer to 3.5%, 3.25%, 3.5% next year. Now, what will be the impact of that? That's much more uncertain, and it makes the path of policy next year uncertain. And I'll mention 2 reasons why. And it might be something to keep in mind if you're interested in this. The Federal Reserve is trying to determine how restrictive policy might be and how restrictive it should be. And in order to do that, they have an idea of what the neutral interest rate is. What's the interest rate that is not going to slow the economy down nor speed it up? What interest rate is that? Well, there's a lot of theory behind that concept. There's a lot of measurement problems in trying to discover it. And there's a difference of opinion, both among Fed officials and people in the private market. But they've given us an indication. They have a median projection of the group. They all make a projection, and then we see where the middle is. And it's about, in real terms, in nominal terms, about 2.75%, just a bit below 3%. Now, I just told you a moment ago, they're intending to push, or they're projecting that they may push the interest rate above that level next year. In other words, they want to make policy restrictive. They want to make it a little tighter. They want to make sure they can contain inflation pressures that might emerge next year. Now that has significance not just for the U.S. economy, but those of you who are interested in the global economy, it'll have implications for what goes on in what we now call emerging market economies. The cost of borrowing dollars will get higher. The attractiveness of leaving money in the United States and getting a safe return over 3% might appeal to people, and they'll draw money away or invest less in some of these emerging market economies. There's already indications of that occurring. There's already some volatility entering those other markets as they anticipate this. As people begin to think, why should we be investing in Indonesia or South Africa when we can get a safe return in the United States? So the ripples are already moving across the globe. So the question is, what is neutral? And when they get there, how tight will it actually be? They themselves don't know. And there's a dispute and some disagreement on the Open Market Committee as to what it is. That makes next year's rate hikes a little more uncertain. We're not really sure if we're going to get them. A second consideration is what's happening with the yield curve. Now, the yield curve is the yields that are available on short-term monetary instruments and long-term. The federal government issues short-term bills and long-term bonds. The 3-month bill right now yields about 2.125%, 2.15%, just over 2%. The 10-year, that 10-year debt instrument yields about 3.125%. There's about 100, oh, maybe 90 basis points difference between the two. Now, it's well known that in the course of the American business cycle, when the yield curve inverts, when the short-term rates go above the long-term rates, it's almost invariably, in fact, it always is followed by a recession. So as the Fed pushes up those short-term rates and gets them up close to 3% or a bit over 3%, it's possible the yield curve could invert. It's possible the Fed could be pushing the economy towards recession. That's going to be part of next year's debate. How close can they get to inverting the yield curve without causing a recession? They themselves don't know. Financial markets are concerned about this. And there's a lot of debate going on whether or not the Fed can actually follow through on their intention to raise rates as much as they say. And what's the dilemma? If they don't raise rates enough, given the robustness of the economy and the ebullience in financial markets, maybe we will start to see more inflation. But if they raise them too much, they might push the economy into recession. That's not the current problem. It's not today's problem. It's not the problem in December or even next spring. But by the middle of next year, it could be an acute issue for monetary policy and for financial markets, both here in the U.S. and globally.
So it sounds like we have to watch this space very carefully. And what I'm hearing from you is Fed policy seems to be set in the near term. In the medium term, obviously, there's some variability here. I guess two practical things just as a follow-on, maybe drawing Kathy and Mike into this, is consumer confidence is at an 18-year high from what I saw the other day. So consumers feel good. As I was saying earlier in my intros, the business world feels good. So with this change that is going to be happening, how is it going to play with those two groups specifically? Consumers, in relation to practically how are they going to think about this over the course of the next 18 months? Anything over 18 months, I think we start to get into basically prediction land. And then business-wise, how does it sort of play out with CEOs in relation to how much confidence do they operate in knowing that this policy is set?
So I'll take part of that, and then you can maybe add to that. Certainly business and consumer confidence, you're right, is at, let's call them relative highs, right? So 18-year highs take us back to about 2000. I mean, not coincidentally, the labor markets are about as good now today as they were in 2000. So when everybody's employed, when people think they're employed fairly at commensurate with their skill set, when income is growing, perhaps albeit modestly, it's not surprising that households would have a good view. We just passed a very large tax cut, albeit it's temporary in nature. That supports households. The corporate side of that is more permanent. So corporates are receiving a pretty high level of after-tax income now, and profitability is quite high. So the current view, and even kind of the 6-month view, it feels good, and it should. We've come a long way since 2008. What it means, what the situation that you just described, what it means is it's going to be more expensive to borrow, whether you're a firm or whether you're a household. And the portion of consumer spending that is most sensitive to this, you mentioned both of those, autos and housing. So not surprisingly, you would expect that households will be doing a little less of that. And I would say, as it pertains to the corporate sector and the business sector, we have people. I'm going to be a two-handed economist at the moment. I kind of have to do that. It's who we are as a people. On one hand, yes, current growth is good. After-tax income is higher, and we lowered kind of the after-tax cost of capital. Maybe that supports business investment. On the other hand, we're doing a lot in the realm of protectionism, which I know we'll get to at some point, and immigration policy is quite restrictive, and the international architecture is kind of fraying at the seams. So there's a lot of, say, longer-term uncertainty, and this will at some point the business sector may look and say, oh, interest rates are higher, we may be nearing the end of this cycle. I've got these protectionism and immigration issues to deal with. Do I really want to embark on a multi-year, multi-million or multi-billion-dollar capital investment plan, or is it easier to buy back shares, increase dividends, do a little M&A activity? So I think we have the balance between, right now things do look good because of what fiscal stimulus is doing, and it's the job of the Fed to temper that.
Yeah.
And at some point the balance may shift.
Any additional thoughts?
Yeah, just to pick up on that, Michael made a lot of good points in there. One, I just want to say that he previously worked at the Conference Board, so they produced the Consumer Confidence Index, and as Michael pointed out, the labor market conditions and employment have a very big impact. 3 of the 5 questions are related to employment. So with the unemployment rate so low, initial jobs claims at 50-year lows, not surprising at all, and income gradually rising, wage growth, not surprising to see consumer confidence up. But as Michael said, we play the one hand, and on the other hand, the two-handed economist. When I see indicators like consumer confidence, the yield curve that Kevin mentioned, and other indicators reach highs or levels that precede or at the end of the later portion of a business cycle, you start to worry, what comes next, and you look ahead to the medium term, and then there's a lot more open questions. So, are we sort of near the peak of the business cycle? And I think that's sort of what Michael was also pointing out. And he mentioned trade. So you throw in the trade tensions on top of everything else. You have the Federal Reserve raising interest rates. We have a late business cycle. You have a late business cycle that has quite a bit of stimulus that's been injected in. And now we have these trade tensions. So what we do at Oxford Economics, we try to quantify a lot of these factors. We use our global economic model. And what we can estimate is if you look at the combination of Fed tightening so far and what may happen over the next year. Now, we're in the camp where we think the Fed's going to actually do a little less tightening next year, just 2 rate hikes. This year, they're probably on course to do 4. But then you also put in the drag from increased tariffs, and they continue to escalate. That actually could essentially offset the fiscal stimulus. So you're talking fiscal stimulus probably adds about 0.6 to GDP growth, we think, in the U.S. for 2019. The trade, the increased tariffs, and Fed tightening can actually offset that. So we're looking for growth to slow from about 3% this year to about 1.6% fourth quarter. So it's a notable slowing. And then when you go even further out to 2020, then you have even additional headwinds because the fiscal stimulus, essentially the short term could start to expire, and you no longer get that boost to economic growth unless, as Michael mentioned, it's not short term. It doesn't just increase or rev up demand, that you actually start to see increase in investment, and that increases the capacity of our economy more long term, so medium to long term. And that's the supply side of the economy. So you've got supply and the demand side. The question is, and ultimately always when they do so-called tax reform or tax cuts, it's really with the hope of having this being a medium to long-term impact. And there's a great debate. Our view is we're skeptical that it's actually going to have a very big or long-lasting impact. If anything, what the long-term impact is it's blown out the budget deficit, and Treasury supply borrowing needs to go up. So it is an interesting time now. Things look good now. You need economists to come in and say, but wait a minute, there's too much sun. We're going to get some kind of skin cancer or something, and we need sunglasses, right? So that's what we do. But the reality is it is quite sunny now, but those are things that we have to look out to the medium-term horizon and that we worry about, frankly.
No need for sunglasses today.
Yeah, right.
Maybe switching gears a little bit, or actually maybe a tag on to what we were just talking about, government intervention in relation to what else do you think may play out over the course of the next year or so, and what the impact may be for the next 4 quarters and as we roll into 2020 with the dreaded R potentially on us.
The dreaded R is a recession. And it's surprising in a way. You're asking about government intervention, but I'll just mention, since you did interject the note of caution about a recession, that it's very interesting to me as an observer of financial markets to note that a lot of investors, a lot of people in the markets are actually concerned about a recession in 2 years. Things look great right now. And normally when they look this good, you see the stock market's up, and you normally would think that bond yields, interest rates would rise a lot as well, and they're not. Interest rates are still low. Long-term interest rates are hovering around 3%. That's not very high. And so it's an interesting question to ask, why aren't lenders saying, give me more money? Why aren't borrowers out there taking up as much cash as they can get in order to invest and do things? Interest rates aren't rising. One reason is, as people look forward down the road a year or two, they think, it might not be quite that good. And so people are still holding on to cash. They're holding on to investments that they invest in the bond market and keep interest rates down. It's a curiosity at the moment to see such a strong economy and to still see interest rates as low as they are. There is caution in the markets right now. As far as government intervention, that's a broad thing to say. It's the biggest intervention is in the tariffs. That the Trump administration has just imposed a new round of tariffs on Chinese imports from China, 10% on $200 billion worth of goods, and that scheduled to go up to 25% in January. They've already put 20% tariffs on what was it already? I think over $100 billion worth of goods. So let's say it's $300 billion and a 25% tariff. That's a lot. $75 billion. That's a tax on people who import goods from China, whether it be intermediate goods that go into, say, the electronics that we buy, or direct final goods that some consumers may be buying, say, furniture or ceramics that are coming in from China. So this tax is likely to offset some of the stimulus we're getting elsewhere in the economy. It hasn't happened yet. It's gradually coming in. It'll slowly make its appearance over the course of next year. But there is a tax coming, an offsetting tax to the fiscal stimulus that has already been.
Do you think a tariff like that specifically will affect behavior in relation to what people do around actual buying habits and manufacturing?
Yes. So how does it affect behavior? When I say it's a tax, well, let's say, we have to pay a tax and that's it. Like a tax on gasoline, you can't escape. You have to pay it.
Yeah.
But in fact, you can escape this tax. It's possible to substitute imports from China to other countries. Laptop computers, well, they can be imported from Taiwan. Electronic components can be imported from Korea. Furniture, well, Vietnam. There are lots of places that can substitute for goods coming in from China. So the change in behavior is likely to be, which is the intent of the Trump administration, to push imports away from China that have come to America and get them from other countries, to reduce the economic interaction between China and the United States and increase economic interaction with other economies. That's
Is that a good thing?
I believe it's intended for long-term strategic purposes, and that's something the Foreign Policy Association would, those are the kind of topics that I think people in this audience are keenly interested in. And I think the intent is not just to change the economic situation, but to change a long-term strategic balance. That's why it's possible that these tariffs are not temporary. It's not, well, we'll put this tariff on until you agree to do something that we want you to do. It may very well be these tariffs will be in place for a long time.
Catherine, let me draw you in from closer to home, NAFTA, and any thoughts in relation, obviously lots going on, Mexico, Canada.
Yeah, I think that we've made some strides with Mexico, so it looks like some agreement there. I think the ongoing disputes with Canada is getting a lot of attention in the media, political. But we were talking earlier in terms of the economic impact and the sectors affected. It's quite small. The dairy sector, there's a big sticking point, a lot of contention, but it pales in comparison to the auto sector, for example. So I think eventually my expectation will be Canada may come late to the game. They've even, Lighthizer and others have held out the possibility that we strike a deal with Mexico first, and then over time Canada joins. Maybe it's due to politics, elections. I think there's an election in Quebec coming up in Canada. So Trudeau has to play his cards a certain way. And then if we have the mid-term elections, I think the Trump administration would like to have a big deal and have something to tout ahead of the midterm elections. But I think the bigger issue is, what Kevin said, is China, and I fully agree that this is not a short-term play. This is for the long term, and I think that's 2 points I would make on that. One, I think the financial markets themselves are just sort of coming around to the idea that this is really a long-term process and strategy. Because I think at first there was big doubts that no, we're really not going to have a trade war with China. We're not going to go to full-out tariffs and 25% on 500 billion of imports. That would be an economic a dent to us and harmful. So why would we do that? And the consumers won't stand for it, right? Because we're and Apple and companies like that are so reliant on the supply chain. But I think indeed Navarro, Lighthizer, who are advising the president, again, many of you will know this just as well, or if not better than me. But I think their intent is to destroy the kind of the reliance, that supply chain interdependence, or diminish it greatly. So I think the financial markets will be interesting now. Still, the equity market's doing well. Maybe it's because interest rates are only going up gradually, and we had a big corporate tax cut. So after and profits are so strong even before taxes. So maybe this was sort of the right time. I know that they planned it, but sort of stumbled upon it. It was the right time if you're going to have a trade war. Do it when the economy's really strong and you've put enough fiscal stimulus in the system to prop up and help buffer the negative impact. So I think that's one thing. I think the other thing is on the security issues. I think security and a long-term strategy in terms of economic prowess. I think the U.S. and also I would probably add Europe in there as well, and other countries are quite concerned that China's moving up the value chain quite rapidly. So they're really moving into higher value-added, more sophisticated technology sectors. So they're no longer just viewed as the lowest cost provider in the global factory for the economy, the global economy, but they can really start to rival the U.S. and Europe in these higher value-added areas, which has intertwined in that security concerns. But also that's a bedrock, and that was sort of our golden area of economic opportunity. And to see China start to compete, I think, is really unnerved both parties, I think, both Republicans and Democrats. So we were talking earlier, could this change with a new president or a change in administration? I'm not sure.
Yeah. And I was going to hit on that. So the permanency of this, it sounds like this is here to stay for a bit.
Yeah, so I would associate my remarks with both Kevin and Kathy, as I agree with that. And I would say it's also, this is why I think your comments about how people are going to react and likely to react is really important. And so I think the message is, from an economic point of view, as long as it's just a bilateral trade war, whatever phrase you want to use, skirmish, tensions, trade war, as long as it's trade tensions, say, just with China, that there are off-ramps for NAFTA and there are off-ramps for kind of Europe-NATO relationships. If it's just a bilateral trade war with China, these numbers are big and they are important, and certainly there's a big value chain linkage there, but over time, the point is to rebalance trade. So trade with China may go down, but our overall trade may not go down. We'll just find different sources and destinations. It may take 5 to 7 years to do that, and maybe a second best source that's a little more expensive. But on net, it's something that should be absorbable and digestible, because trade is actually a pretty small share of the US economy. It's more important to China than it is to the US. So yes, there are costs, but like Kathy said, we have the stimulus, and we should be able to offset it. Now, who's certainly feeling it, I think, is emerging markets, right? So who's caught in the middle are the smaller countries that feed into both of us, that are more reliant on trade than either the US or China. So we have big bases in terms of overall economies. Trade is a relatively smaller share. In many emerging markets, it's the other way around. So we're not seeing it in, say, US financial markets in terms of, let's call it excessive concern and volatility, but we're certainly seeing it in emerging markets. So I think it's having an effect. It's just, I think markets are trying to say, it's more important over here than it is over here, and they're trying to dissect
And what I'm hearing from all of you is, so it really doesn't matter who's in the White House in 2020. This is going to be here for a while because a macro goal for both parties.
Yes, I think so.
Okay.
Because after all, TPP was started before this and was kind of a security policy wrapped in a trade policy. So you could argue that the direction of travel is set, the intensity and tools may be different.
Yeah.
Sorry, I didn't mean to cut
No,
you
no,
off.
I was just gonna, are we going to take questions? I know we're
Yeah.
talking a lot, but
I wanted to hit.
I sometimes worry we run out of time.
Yeah, no, I
It's
agree
a
with that.
disappointment if we don't get a question.
One other topic in relation to if the recession is potential recession is right around the corner. Do you think we as an economy is ready for that, and which sectors do you think will be most hit with a potential R?
So I'll just make two quick points of that. It won't cover everything.
Yeah.
Are we ready? In one sense, yes. The financial sector's on much more sound footing today than it was in 2008. Capital levels are higher. We think the system's more resilient. So the type of economic recession intertwined with financial crisis, lower probability that happens. That is potentially the good news. The bad news is we just did a whole lot of fiscal stimulus now, and I don't know exactly where your forecasts are, but I'm guessing we all have federal deficits on the order of about $1 trillion next year, more or less. And that would be where most people think the peak of the business cycle is, and the unemployment rate closing in on 3%. So if you do have a recession, that deficit's only going to get wider. The ability to use fiscal policy in a counter-cyclical way to respond to any downturn is now much more limited. So those would be 2 points that I would make.
So let's actually go to the audience and start asking some questions. So I don't know if we have a mic out there.
Hi. To what extent is the long-term interest rate affected by global capital flows, and are the trends affecting those global capital flows that are keeping the interest rates low? Are those long-term sustainable trends?
So for those of you who didn't hear, the question is about long-term interest rates and global factors that may influence the long-term interest rate here in the U.S. As I mentioned earlier, the Treasury's 10-year note, as it's called, is yielding about a bit more than 3%. And I said that was low. And one reason why, as the gentleman just suggested, is because in other major economies, other advanced economies in particular, interest rates are even lower. And financial markets are highly integrated now all around the world. Investors, financial investors, can invest in Europe, they can invest in Japan. These are deep markets with a lot of debt instruments that they can buy, bonds they can invest in. And so, of course, people are always comparing the interest rates that are available in different economies. In Japan, the Bank of Japan is following a policy where they're pegging their 10-year rate close to zero. It's about 10 basis points right now, a tenth of a percent. So Japanese investors are naturally looking for higher yields. And 3% looks very, very attractive. In Europe, the European Central Bank is still pursuing a policy of quantitative easing. They're buying bonds all the time, sovereign debt from the various member countries. They even buy corporate debt. And so they're pressing down on interest rates. And the benchmark there is the German Bund, the bond issued by the German government. It yields about 50 basis points, 0.5%. So yes, these international factors are very important. Financial capital flows to the United States, looking for a safe asset with some yield. If those interest rates weren't quite as low as they are, it's likely interest rates here would be higher. But they are. And we can't eliminate Europe and Japan from the world economy. They are there. And so it influences what happens here. That raises a question of whether interest rates are too low in the U.S. That's part of the debate that's going on in financial markets. And if in the coming year, for example, the European Central Bank stops quantitative easing, they stop buying bonds, they raise their interest rate a little bit, if that were to happen in Japan, it would reverberate back to the United States. There's some thinking that would happen, but at the same time, there's that concern about the eventual slowdown. So, markets are kind of weighing these two things. But you raise the point that international factors are important, and they're important for the Federal Reserve as well. The Federal Reserve, in some aspects, is the central bank for the world. The dollar is the international currency that's used everywhere to measure values, and people borrow and lend in that currency. And the interest rate in the United States is the bedrock on which interest rates rise and fall throughout the world. So when the Fed tightens policy, it tends to tighten monetary conditions everywhere. So it may be that these international factors are actually going to be a restraint on the Fed next year. We may find that the Federal Reserve is looking at the U.S. economy and saying, well, we should tighten up a bit. But when they do that, something breaks somewhere else in the financial system, and they have to stop.
Next question.
Thank you. I'm wondering if the panelists would hypothesize, if the Fed is making a mistake by gradually raising interest rates, do you think the mistake could be that it's too gradual, that we find out inflation goes up high and they have to rapidly raise rates? Or do you think it's more likely that we would find out in hindsight that they made a mistake by raising rates gradually, inflation doesn't really come back, and they've raised rates too high that way?
Mike, you want to take that?
I think it's very low probability that there's an inflation surge out there. We try to find it, and we try to scenario it out in our modeling frameworks, but it's very difficult, I think, to get an inflation situation that makes the Fed think, wow, 25 basis point hikes a year is not enough. I think you could tell perhaps an ancillary story to that financial conditions become a little exuberant. But I think on the balance of risk story, most of what I've heard from the panel is the risk next year isn't that they go more than 4 times if you were to extend gradual. I think the risk is that they go less. So I think the balance, and that's not so, I just qualify that by saying that's not so much an admission that they made a mistake as much as I kind of think when they stop, they're going to stop. So if they only get in 3 next year, it's a recognition that perhaps they were a little aggressive on where they thought the terminal rate was. But I think most people think the balance of risk is skewed to getting fewer Fed rate hikes than more. So I think that's the way I would answer it. Do you want to?
So you think there's almost no chance they're going to make an error either way?
So it depends on your definition of error. Here's what I think will be key for me to look for later today, and I think which kind of are they writing, or do they want to raise the unemployment rate, right? So they have their dual mandate, an inflation rate of 2% over the medium term, so on average inflation over time. And they think that the natural rate of unemployment they think is around 4.5. It's sitting at 3.8. We kind of think it's going to continue to drift lower, so does the Fed. Are they willing to accept an unemployment rate gap of, say, 1 percentage point? Do they feel they need that in order to keep inflation where they want it to be? Or are they saying, maybe we should tip that a little higher, because if we don't, we're worried about potential risks further down the road? And history would say the ability to tip that just a little bit higher is somewhat folly. And so once you lose momentum, you tend to lose it more than you want. You overcorrect. So is that a mistake? It would, the counterfactual would be very difficult, of course, to prove. But that to me is what's key today is, do they feel like they need to get policy tight in order to actually lift the unemployment rate a bit? Then the history would say that's a very difficult balancing act. I know I skirted your direct question, but...
Question from this side? Mike's on.
I keep getting concerned about the skyrocketing federal debt, and I'm wondering how and when you think this is going to affect Wall Street and capital markets.
Kathy, you want to?
Sure. Yeah, that's a great question. I think those worries have persisted for a very long period of time. And as we just discussed, even though the Fed is in a tightening phase, actually rates are still very low and probably poised to stay very low, because the neutral Fed funds rate, even if they go slightly over it and become restrictive, it's just we're much lower than we have been in previous business cycles. and ironically, I should add, if we do go into recession, I think one of the things that I worry about is actually going back to the zero lower bound, right? Going back to zero interest rates and what do they do in terms of balance sheet. But getting back to the deficit, I think, inevitably it has to be something that's worked out. Now, there's one school of thought that's sort of optimistic and saying, hey, we're the world's currency reserve, and we still have the safest assets. We have the most liquid debt market. And in times of trouble, we see a flight to safety, and there's safety here at home. And given that interest rates are still low in the rest of the world, that also helps keep our borrowing costs low. And so for now, we can fund the deficit without any issue. Of course, yeah, and the debt. So obviously, as the baby boomers age and we have issues, one would think that there does ultimately have to be something done with the entitlement spending. If you go back to the Greenspan Commission, I think in the early 80s, they gradually bumped up the retirement age and did things very gradually. It would have been really terrific if that continued and there were gradual adjustments made all along the way. That hasn't been the case. But an optimist would say, well, we still have time and it'll take many bites at the apple, but we'll get there. But I think it is a big uncertainty. Do we have some kind of debt crisis? Do we have an entitlement crisis? Which is only exacerbated by the increasing inequality that we see existing just even in incomes, right, and household assets. So, and we know it's more the Medicaid and Medicare, and Medicare particularly, than Social Security. So what changes happen? Another, not just to be on the optimist, because I do think there's terrific concerns about that. My guess would be we cut back on the entitlement spending. And it could be quite wrenching if not done start immediately. On the other hand, people would argue, well, we could have a technological revolution in the healthcare sector, which there's been some gains and there's potential for that. And maybe that will help temper the costs and the projections on that. So the other idea, which I would not subscribe to, I'm sure if they want, Kevin or Michael want to weigh in on it, is also the idea again that, well, maybe we need to boost productivity and potential GDP growth, and that will help afford and pay, help us to manage the debt and deficit because we'll be bringing in more revenue because of that.
Next question.
Hi. I would be curious to hear your views on how you think tariff policies, not just in the US but globally, can structurally impact the productivity and production of certain goods here domestically in the US. Is it a powerful enough tool to change the direction, bring back what has been offshored over the past decades, or you don't think will go that far?
Who wants to take that?
I would say reshoring the old jobs is probably not going to happen. And our models would say if you increase tariffs or move towards more protectionism, yes, you will reorient some more production and let's call it those types of jobs you'll have more of here. But you're likely to have lower overall employment. So you would gain employment in the protected sectors, but you would lose employment in the remaining part of the economy. So think of an economy that would be this large without protectionism, this large with protectionism, and so overall employment may be a little lower in this world. If not, then it's likely that productivity would be lower. Maybe we're all employed still, but we're producing a smaller pie, which would mean productivity and wages on average might be lower. So my view is I think the actual employment outcome is a bit uncertain. If I assume kind of one thing, I can get a result. If I assume something else, it's more of a productivity and wage story. But historically speaking, the incidence of trade, so the share of trade in world output, is associated with productivity. I say associated because we're not quite sure which way it runs or the causality or so forth. But the more trade volume grows as a share of GDP, the more productive things tend to be. The more you throw up barriers, the lower productivity is likely to be. So that's kind of how I would slice it. Yes, you could increase employment in protected industries, but it's going to come at a cost somewhere else, either employment somewhere else or say overall productivity or average wage growth.
Question in the back?
So I'm Sarwar Kashmiri, fellow of the Foreign Policy Association. The dollar is the settlement currency for trade, global trade. And I'm wondering if you have any opinions for what China should do if it wants to make inroads in that area.
Kathy, you want to maybe take that?
Yeah, so the question was that the dollar is the dominant currency in global trade right now, and really the world's reserve currency. And what I think the question was, what inroads could China and India make in terms of China?
And specifically for trade.
In terms of trade. Well, I think that we're afforded that special status not just because we're so a large dominant economy in the world, but it's also because of our political system, and also our capital markets are so deep and transparent. So I think, for China to make, gains or try to rival that, to be, they can diversify into other currencies, right, in terms of central bank and management. But I think it would be quite a ways off, if at all, for them to be able to gain the trust, I would think, of global investors, and even for for trade to rely on the yuan as the main global currency like the dollar. So I think it's beyond that. Now, we may have eroded some of our credibility with some of our policies and how we're doing things unilaterally in the trade front, but I still think we're seen as sort of the beacon.
Other questions? Mike's coming down.
So a lot of the emphasis on Wall Street has been with interest rates, but technology has the potential to revolutionize the world. And it seems that underlying this tariff battle is really whose technology is going to succeed. Where is that growth going to occur? Is it going to occur in China? Is it going to occur in the United States? If it occurs here, we generate the revenues to pay the debt. If it occurs there, we don't generate the revenues, and that affects the outlook for American technology companies versus non-American technology companies. What's your outlook really in terms of on the technology front?
Who wants to take that?
I'll give you my opinion, but I have to admit I'm not a specialist in terms of engineering or technology. Most of what I know is about financial markets. But I think there's, from what we have observed in the last few decades, there does seem to be something called the first mover advantage. That when a lot of these technologies that we've become accustomed to, or that we talk about, rely very much on network effects. That they're not an isolated thing where you can have a hotel system where every hotel stands by itself, and if one went down, it doesn't matter for the rest. But network systems are highly integrated so that they operate as one large system and not as individual components. And so being first into that and creating the network is what gives a big advantage. At least that's what I think we've seen in the last decade or two. And so some of the advances that we hear talk about, things like 5G, the next level of internet connectivity, and how fast it's going to be, and how it will connect to so many other things, and how very, very tiny components will all be linked, and we'll have millions of these things in our pockets, or maybe in our heads, who knows, in our vehicles, and so on and so on. So being at the forefront of that is important to gain that first mover advantage, the advantage that creates the network. Because if you don't, then you're outside, you don't get in. And I think that's part of what's going on right now, and why there's a question about government support for this type of investment and these types of developments. And does it make more sense to have a central government promoting it and directing investment, and have state enterprises and so on push forward in that direction? Or does it make sense that you have a deregulated system, as say we do in the United States, and let the private sector just get out there and get it done? There's a debate going on at high levels of who's going to succeed in that. And there you are in a foreign policy question about how do you organize your government policy around these issues. I don't have any answers. I'm just reflecting back to you the few things that I know that I think are important in that area. And it doesn't have a whole lot to do with financial markets.
So let me just bring this to an end as we get to the top of the hour, but before we close out, one prediction from each of you in relation to things that you're comfortable making a prediction for the next 12 months. Maybe I'll start with you, Kathy.
So next 12 months, I would put less than, 20% odds of a recession in the next 12 months.
So I would say, I think the unemployment rate's going to go to 3% by the end of next year, and I do think we get 4 hikes next year.
So that's bold.
He asked for that, so.
I mean, I think it's one of the things about, forecasting, as an economist, that's a big thing. We're always asked to forecast the unemployment rate. And I think in general, we've all been very hesitant. 4%, that's so low. 3%. But I wouldn't disagree that we could get that low. And so the consequences of that, I think, are, and I'll follow on, Mike is saying that perhaps the Fed will be aggressive next year in raising rates, that we'll see a lot more financial turmoil next year than we will this year, because we will be dealing with the contradictory nature of tariffs versus fiscal stimulus at the same time that interest rates are rising, and there'll be some expectation that that low unemployment rate we'll be watching it turn. There'll be a lot of concern over where the economy can go in 2020. So what's my prediction? Financial volatility, particularly for riskier assets, and that means the stock market.
Perfect, thank you. Well, thank you, panelists. That was a very, very interesting conversation, so thank you for your time today.
Thank you.